Will the latest Trump tariffs provoke global trade wars? What will be the implications? Over the weekend, Donald Trump signed orders implementing tariffs of 10% on imports of Canadian energy plus general levies of 25% on Canada and Mexico, 10% also levied on China. The most part of Canada's 4 million barrels of daily crude exports flow to the US to refineries in the Gulf Coast. Canada has responded with 25% tariffs on US goods, Mexico also. Hello, this is Bode Oshosami on Global Business Insights, where you get fresh perspectives and discussions on the business headlines. The Canadian and Mexico tariffs will stay in place until a national emergency over the drug fentanyl and illegal immigration to the US ends. Tariff collections begin on Tuesday, according to the order. It's still not clear what the agenda is. Will tariffs be reversed if stated objectives related to immigration cooperation and stopping drugs inflows are addressed, or is this going to force an early renegotiation of the USMCA, that's the North America's trade bloc deal, the United States-Mexico-Canada agreement? What will the retaliation and counter-retaliation scenarios look like? Uncertainty sours sentiment, and it was no surprise that as early as Friday, major US indexes were already taking a dip. Much depends also on how easily businesses and consumers are able to find non-tariffed imported or domestic substitutes, what the elasticity of demand is going to look like, competitiveness and ease of doing business factors, especially the nature of entry barriers, access to capital and flexibility of the supply chain in the affected regions. Inflation of costs will definitely weigh on US economic growth. According to Bank of Canada, in their study of the impact, at the minimum, they see a short-term one-time spike in prices, which may not lead to ongoing inflation if it does not lead to a retaliation spiral. The president of the European Central Bank, Lagarde, also commented that higher inflation is not an obvious consequence. Businesses that use tariffed inputs will try to switch to substitutes, and indeed, because of the ample lead time they have had, most would have contingencies to respond. But there will be higher costs, which potentially erode profitability. Also, for governments, higher tariff or counter-tariff revenues will augment fiscal space and can be used to pay down debt and finance higher cost of living palliatives, grants, or tax cuts for citizens. Looking at the goods involved, demand for energy can be highly inelastic, and switching to cheaper substitutes can be challenging. Also, the motor vehicle sector, which tends to have a highly integrated international supply chain, may struggle to switch to domestic components. Tesla, with Elon Musk seen as a Trump ally, could be targeted as part of retaliation measures. Canadian Steel feeds the US auto sector, which supplies components to assemblers also in Canada, and also hit by counter tariffs before the finished vehicle is exported back to the US, tariffed again. In some cases, there are multiple points of extra costs, which will definitely make these cars much more costly and erode demand. The Bank of Canada, in their study, also add that with less demand, Canadian exporters will lower production and lay off workers, which negatively affects the rest of the economy. Beyond US, Canada, and Mexico, there is collateral damage. Import-dependent economies will be burdened with higher cost of manufactured goods. Less developed economies with no efficient industrial capacity to switch to domestic alternatives will import higher inflation. Already, many global players are dodging tariffs on imported inputs. LVMH boss Bernard Arnault says he's moving more production into the US. And there are winners. Efficient supply chain actors like Vietnam, Malaysia, and Singapore are strongly positioned as alternative suppliers for more expensive China goods. On oil, the US in theory can produce all the energy it needs, but exploration, drilling, and production may require investment and energy infrastructure expansion. The US can deplete its strategic reserves to replace Canadian oil and replenish when new expanded production is fully on stream. On the geopolitics, Canada is in the middle of a political transition that will settle in a few months. A new leader, McCartney, former Bank of England governor, is taking over. Trump is still in the honeymoon phase of his presidency. The phase may be shortened by the impact of a trade war. Inflation has just left a bad taste in the mouth of voters, and the trade war, reviving inflation, is definitely politically toxic. To summarize, the imperative to be an efficient, competitive, and diversified producer of goods has never been so compelling. Import dependence can be fatal. Developing economies have to find sweet spots where they have competitive advantage and invest in radically transforming capacity to add more value and play more prominently in global supply chains. The other trend that we can expect is the acceleration of innovation with resource-efficient business models, recycling, shared assets, product-to-service models, digital intelligence, manufacturing. Indeed, any new operating and delivery resource-efficient operating model that can offset costlier forces at play will see traction, and those who respond with new innovative ideas in this area will be among the winners. To another major theme in the business world, still in the US, Nvidia on Friday met Trump to discuss reducing Biden export controls and restrictions and how to strengthen the United States in artificial intelligence leadership. In the context of recent geoeconomic developments and the rising China leading a BRICS alliance, the US cannot win with protectionism and must innovate smarter. Losing the lead in AI can be fatal to aspirations to remaining the leading economic power. Meanwhile, analysts are observing the latest AI developments and optimistic that China's DeepSeek's open source models delivery of cost savings compared to other large language models implies higher efficiency and lower costs. In other words, mass market or cheap AI will accelerate faster adoption of AI and a surge in productivity. Others caution that this is not going to happen immediately. Startups will benefit if AI is more affordable as they look for tools to reduce their cash burn. Juliet Anammah, chairman, Nigerian Breweries, and founder of CG&L Strategy LLC, also former CEO at Jumia and former Accenture senior executive, speaks on how an initial digital-only AI model can be helpful for startups.
Startups struggle with cash burn, particularly before they reach two significant milestones. One is profitability. The second is any other critical milestone that investors are looking for before they extend more funding to the startup. There are three things that normally burn cash very quickly, and I call those the three horsemen. One is hiring talent. Second one is leasing physical office space. And the third one is, of course, investment in capital goods or capital assets. So there is a model which I typically recommend for startups in the early years to conserve their cash. And I call it a digital-only AI-first model. Basically, it means digital-only is very straightforward. It means that the startup is operating exclusively online, no physical space. AI first is more nuanced. AI first doesn't mean you only operate with AI tools and there are no human beings running your business. No, it means that once you have defined your process architecture and determined and also broken them down into specific tasks, it pays to first of all see what kinds of AI applications are available that you can leverage in running some of those tasks. To the extent that those AI tools can run those tasks reliably and more cost effectively, it's worth considering using those tools to run them. And there are several examples. AI tools have been used in so many different ways, but Some of the examples of areas are, of course, in customer service. Virtual assistants can run, respond to repetitive customer inquiries, can be used for 24/7 support. But there's a caveat. Every single human being does not like the experience of when you call a customer service center with a request or a problem and you're being taken on a run around by a virtual assistant who doesn't quite understand the nuances of the specific problem that the customer is experiencing. So it's very important to complement AI with human interactions. People still need to talk to someone in customer service. Other areas where AI has been deployed quite effectively are such areas as in marketing. So analyzing customer data and coming up with more personalized marketing campaigns for customers that can drive better engagement and conversion rates. Very, very critical, very good. Recommendation engines, they've been run for decades with artificial intelligence tools. In, let's say in finance, okay, so automating forecasting, financial reporting, expense tracking, those kinds of things can be done with AI tools that are currently available and can then release time for finance team to focus on more strategic areas. Process automation also, so invoicing, scheduling, all those kinds of tasks that were handled for decades by business process outsourcing. They're just natural extensions for AI to be able to do those tasks effectively. Even when you look at one other area could be in product development. Yeah. So in product development, coming up with designs, particularly I see that very well in fashion. Runway.ml is a very good application that I've seen in fashion that can come up with initial designs, and then your design team can then fine tune it based on their customer requirements and so on. So there are multiple areas. And the good thing is you have the option of looking at both open source or proprietary applications, subscription models that make it easier and cheaper for a startup to leverage those kinds of applications to work. What are the benefits? Very simple. One is extending the runway for the startup until, extending the runway of your seed funding is one. Two, it also allows the startup to scale fast or to fail fast and fail cheaply. Thirdly is being able to leapfrog in a competitive arena where you have other incumbents. If you don't have to tie up a lot of your cash in capital assets or leasing office space, then it really helps you in terms of cash burn.
Nigeria January Stanbic IBTC S&P Purchasing Managers Index just in posted 52.0, down from 52.7 in December, a second successive monthly expansion as high inflation continues to weigh on the economy, also as the naira appreciates to 8-month highs. Eurozone January manufacturing flash PMI also just rose from 45.1 in December to an 8-month high of 46.6, but still in contraction territory. China Caixin Manufacturing January Purchasing Managers Index expanded slightly, coming in at 50.1, slightly lower than expectation. UK Manufacturing PMI January just in posted 48.3, that's in contraction due to weak demand, low confidence and rising costs. In her budget read on Saturday, India's finance minister gave consumers about $11.5 billion in tax cuts as she moves to shore up a slowing economy amid growing global risks. Asia Pacific markets were mostly lower as global stocks are today digesting the expected blow of tariffs announcements after a strong January. This week also features the US January non-farm payrolls and earnings releases from Amazon and Alphabet as markets look to other catalysts. Well, that's it on this episode of Global Business Insights. You can now watch us on Business Day TV YouTube channel Monday to Friday at 11 a.m. West Africa time. Thanks for watching. This is Bode Oshosami. Bye-bye.